Joining me today on NYSE Floor Talk is John Asbury. He's the CEO at Atlantic Union Bank. John, fantastic to have you here. Thanks for joining me today.
Thank you, Judy. I appreciate the opportunity to be here.
So John, you're here to celebrate the closing of the acquisition of American National Bankshares. Now tell me, what does this acquisition bring to Atlantic Union, and how does it create value for your stakeholders?
A number of things. First of all, strategically, what it does is it increases our density in our home state of Virginia. We are the only statewide independent bank in Virginia. We've been here since 1902. There is no other. American National Bank is based in the southern part of Virginia and operates in western Virginia as well. And so this clearly increases our presence there. Importantly and strategically, they have a meaningful presence in North Carolina, down in the Piedmont Triad and Raleigh. So we use that as a future growth expansion platform. So that would be the strategic benefit of it. Financially, this was a great deal for both shareholders. The market reaction was very positive. It's a good example of a negotiated merger where they only talked to we, and we were able to come to an agreement that at the end of the day created value for both shareholders. So market reaction was very positive. And then I think in many respects, the most important part of all, Judy, the cultural compatibility of the two companies. These companies have had a 40-year relationship. We know them very well. No two companies are identical, but we're actually quite compatible in terms of the culture. So we're very optimistic about what we can do by having American National Bank as a part of Atlantic Union Bank's platform now.
Now, John, is it harder to complete bank acquisitions today? And tell me, what challenges have you faced?
Yes, this is the third acquisition of a $3 billion asset bank during my 7.5 years at the company. And I would say that there are a couple of ways to think about this, Judy. The first and most practical aspect of it, the environment, is really the interest rate movement that's occurred. And so you have to deal with the interest rate marks. When a bank is acquired, the acquirer has to mark to market the assets of the bank it's acquiring. So if the bank has a lot of long duration fixed rate loans and long duration securities, those have to be marked to market. And those marks are effectively hits to capital. So what does that mean? It means it makes the math very hard in terms of the capital impact. So I think that's the first thing. The good news from this standpoint is American National Bank is a very conservative company. The duration of the loan portfolio was only 3 years. That made the marks very manageable. They have pristine asset quality. We also mark the loan portfolio of an acquired bank for credit performance, which was pretty manageable. And they're 15% of our size. So that meant that it's not so large as to be something that would be viewed as creating undue execution risks. So that's kind of the practical aspect. There are regulatory uncertainties. Now, from our standpoint, it took start to finish 5.5 months from application to approval. The process proceeded quite candidly in the normal course. And yes, it is a rigorous process, but in the end, it went through just fine. Different people will have different experiences. So I do think there's much more regulatory uncertainty. So the tremendous run up in interest rates, creating these interest rate marks and capital hits, are a challenge. And then having to deal with more uncertainty than we've seen before in the regulatory environment is a challenge. Upon announcement, this was the largest non-distressed bank merger in America post the bank failures when we announced last July. So we're actually viewed as having been quite bold in making the announcement, but we were also quite confident. And of course, we pulled it off.
Now, banking has been in the news quite a bit lately. Talk through the challenges the industry is facing, and are all banks facing the same issues?
Yes, I would say similar to my comments about making a bank acquisition. First of all, this environment is difficult. So we've gone from effectively a near zero rate environment to this now higher for longer rate environment, still battling inflation, which has proven to be quite persistent. And that's pressuring bank net interest margins more so than anything else. So that has applied a lot of pressure to the industry. So financially, it is a more difficult operating environment than we've seen in past years. The second issue, and what feels very different to us as an industry, is the tsunami of regulations which are coming at this industry. It's not one, it's not two, it's not three. There is literally a tsunami of new regulations which are being proposed or in some cases recently implemented that is really having an unintended consequence on the industry. It is not the individual regulations, it's the cumulative effect of all of them. And I do fear that while perhaps very well intended, and I assume that they are, it's the unintended consequences, the impact on the industry and the impact on the industry's ability to deliver to its customer base is quite a challenge. And I think that this is something that is going to result in ultimately more consolidation, and it's eroding the structural profitability of the industry. At the end of the day, someone has to pay for banking services. Study after study indicates most people are actually quite happy with their bank, and so that is a real problem for the industry.
All right, well, John, it's been wonderful to talk with you. Thanks for joining me on Floor Talk
Thank
today.
you so much, Judy. It's a real pleasure to be here.